Hi there. I'm Alan Kirth,
I'm Jeff Carion.
and my NMLS number is 238808. And yours, Jeff?
1371795.
I'm sales manager at Guarantee Mortgage in Burlingame, California, a division of American Pacific Mortgage, NMLS 1850.
And I work for First Bank Mortgage. My office is located in San Mateo, California. And I don't have my company number yet, so maybe I can provide that at the conclusion.
All good. So now we've covered all the compliance stuff, kinda. We kind of had a plan here that we'd talk a little about what's going on with the market and the confusion that's taking place. And Jeff has been in charge of putting speaker programs forth for San Mateo County Association of Realtors. So we're hoping this might be one of those programs. And Jeff will kind of maybe do a little interviewing and we'll go back and forth here.
Yeah, and why do you say confusion? You think there's confusion in the marketplace?
Well, are you talking about interest rates?
I guess in every facet, I think people are confused in interest rates and the financial markets. And I think everything in life in general has been a little confusing for people. Even the experience of going shopping is a little confusing, right? So however you want to address it, I leave that up to you.
Ain't that the truth? So ask me, what are rates today, Jeff?
Well, okay, that's a good question. You didn't cue me on this, but what are rates today?
Well, it's like Forrest Gump. It's like a box of chocolates, man.
That's kind of true.
You never know what you're going to get.
That's precisely right. Because even on Friday, they thought they're getting this caramel chew. And then at the end of the day, they got this almond, dark chocolate almond with right? I mean, you don't know what you're getting.
Ain't that the truth, though? You know, I look back on just like last Thursday and Friday, where, and I'm actually talking about a week ago, Thursday and Friday, not this last Thursday and Friday. And I was pricing out kind of a regular old standard conforming fixed rate loan, $500,000 loan amount, $1 million value, 760 credit score. So plain vanilla, best rate you're possibly going to get on a standard refinance, no cash out, right?
It should be awesome, right?
Well, that morning was potentially going to be awesome because the Fed had stepped in and been doing buying the day before, so hopefully it helped the mortgage-backed security marketplace, and rates were good.
Right.
Priced out 3.25% at 0 points.
And that is pretty good.
Okay.
Right.
Yeah. And then there was a pricing suspension notice, and it said prices suspended for reprice, and it came out at, ready for this, 3.75 at 0 points.
Did you fall out of your chair when you saw that? Maybe it was a mistake.
Not really.
No.
Expected, And then it priced again later in the afternoon at 4%, then again at 4.25, and then I woke up to Friday morning's rates at 4 5/8. But the bond market and mortgage-backed securities did really well that day.
Right.
So all of a sudden went from 4 5/8 to 3 5/8.
So how do you explain it to people? Because you're right, that is confusing. Why is it?
What's going on, huh? Yeah, it's amazing,
Right.
actually. I think what we first need to kind of explain to people is what really happens in the mortgage marketplace and how interest rates come about. I think people think that all of this is bank oriented and has something to do with the banks, and it really doesn't.
Right.
So let's kind of go back a little bit. Now, if you're getting a jumbo loan in today's market or a commercial loan, that really is a bank oriented product, and old school concept of using the bank's depositors' money to recapture a yield that's market. So the bank is doing what they need to do, and they write their own rules and guidelines. As you know, every single bank, Bank of America, Wells Fargo, Chase, you name it, they all have their own overlays on top of the standard Fannie Freddie guidelines, and especially a lot of overlays on jumbo because they all vary for each one.
Right.
Everybody has different overlays. So, and then you go to the commercial marketplace, and the same thing. Each commercial lender has their own rules and guidelines because they really are giving the depositors money.
Right.
With the exception of what? Conforming loans, right?
Right.
Okay. And we all sell conforming loans. I mean, you work for a bank. What does your bank do with its conforming loans?
Well, we package them up. We make sure we adhere to Fannie guidelines so we can go ahead and send it right back to Fannie.
Exactly. And I work for a mortgage banker and a broker. We're both a broker and a banker. So we kind of have the market, We're talking about the general market now. So we all sell loans to Fannie and Freddie
Right.
in the conforming arena. So how do we lock those loans? What really takes place? So I'm going to help people understand this, because kind of like a teeter-totter. I want you to imagine that we're on either side of the teeter-totter. What we have on this side of the teeter-totter are loans and interest rates. So let's say we're going to lock a 3% interest rate in the marketplace on this side of the teeter-totter, right?
Right.
Well, on the other side of the teeter-totter, we have the mortgage-backed security marketplace. So how does that relate? Well, when the interest rates go up on this side, the price of the mortgage-backed security goes down on that side.
Right.
When interest rates go down on this side, the price of the mortgage-backed security goes up on this side.
Right.
Why is that important? Because what a lender does, they really don't take a risk on locking your rate at 3% for 60 days. And gee, what's the market going to be at the end of 60 days? Let's go see. We'll lock that loan, we'll close that loan, and then we'll go, oh my gosh, interest rates are 2.5%. We just lost our butts.
Right. At least, yeah, that's what you would think.
You know, if they try to sell to Fannie. And what if the interest rates are 4.5%? Oh my God, we had a big win. Do they do that?
No, I don't think so.
No. No, so what they actually do is they buy a forward put in a mortgage-backed security. So it's a future.
Right.
And in that future, and it may not be a mortgage-backed security. There's lots of financial instruments that lenders use to hedge their interest rates.
Right.
And that's what it's called. It's called hedging. So
right.
Keeping it simple, you know, they take the side of the up and down of the teeter-totter, you know,
right.
And if the rates go up where they might have made money, the reality is they sold the mortgage-backed security, they lost money, teeter-totter goes even, right?
Right, balance out.
Okay. Opposite's also true. Rates go down, they lose money, the mortgage-backed security side goes up, they sell it, back to even again, right?
Right. Right.
So here's what happened in the market. The average volume, production volume that was taking place prior to all this going on, prior to you and I searching for refinances, because we knew rates were going down 2 months ago. You know? We saw them going down and we started calling our clients. Well, the average volume that was taking place before that was like 2 to 4 billion a day. That's the average origination volume in the mortgage-backed security marketplace.
Right.
Then it grew to $15 billion a day. So imagine that two great big heavy guys, 1,000 pounds each, got on either side of the teeter-totter.
Right.
What's going to happen? The teeter-totter bent and broke.
Yeah, too much all of a sudden. That started the refinance boom, created.
Right, and that's what we call supply, right? So there's so much supply on both sides of the teeter-totter that just went.
Right.
Now, what happened on the mortgage-backed security side? That big guy fell down and rolled down the hill down to the very bottom. Mortgage-backed security started falling out, but here's why it really fell out. Here's the problem, what we really face as mortgage lenders. We lock that 3% rate in, but what if that loan doesn't close?
Right.
When they go to the mortgage-backed security, they have nothing to counterbalance that mortgage-backed security.
Yeah, it becomes unattractive.
Because the risk in that is so great. Well, that's what happened to the mortgage-backed security marketplace. So about maybe 2 weeks ago, in fact, just before the Feds made the announcement of cutting the Fed discount rate and funds rate, what we had was a huge day of fall off in mortgage-backed securities. So probably one or two big traders made these two humongous trades, and the rest of the market just followed. It's kind of like an avalanche, you know? A big group of ice falls off and the rest of the mountain just follows along with it. So mortgage-backed securities fell off the face of the earth, rolled down that hill. And what you have left is a marketplace that really doesn't have the same risk in it anymore. Lenders don't know how to balance their risk anymore. This is the mechanism they used.
Right. And then under normal conditions.
So what did the Fed do? Now we everybody in the marketplace go, oh, interest rates went down because they heard the Fed reduce rates, right? Did your rates go down the day the Fed reduced interest rates?
But they said, well, the clients, and I'm sure they reached out to you as well and say, hey, I heard rates are zero. So they're thinking maybe their mortgage rate should be somewhere in that vicinity as well. Right. And that's what everybody thinks. So, right. And that's why I got all these phone calls. So what was the proper response that we had to kind of inform or educate our clients?
Well, on that day, they actually had gone up.
And they're going to wonder why. And it did. Because there was a key thing in the Fed announcement that actually helps at least stabilize the pricing for momentarily, and which people are not aware of.
Yeah, exactly. And what we normally see is when the stock market goes up, rates, you know, go go up with the stock market, so to speak, because
Right,
as the stock market's going up, money's going from mortgage-backed securities into the stock market, so rates are actually hurt by that. When we see the
right,
stock market really go down, we tend to see rates improved by it. And then
right,
we also used to look at treasury securities as an
right.
indication, right, of what's going
And
on.
generally, right, under normal conditions, they would correlate, they would price in line. But right now, there's no alignment.
None whatsoever. So
Right,
what's really happening is, and the really good news, it wasn't the Fed's reducing a discount rate, because that's a 1-day overnight banking rate. It's not a
right,
30-year mortgage. So what the really good news in that is that they started giving 200 billion to mortgage-backed securities and 500 billion to treasuries.
right.
That was the good news.
But the key thing you said was 200 billion. And what's the daily volume?
Yeah, you got it. So how
Right,
long was it going to last?
right,
So what they did was they come in and start buying in the morning, and then they fall off, and there was no market left for it. So he'll still have that guy. Imagine that big old heavy guy that fell off the mortgage-backed security side of the teeter-totter, right?
right.
So
Well,
here's
he
the
got a
Fed.
little boost. He got
Yeah,
a
well,
little
the
boost,
Fed's
and what?
pushing him up the hill,
Right.
and they
And he
push
was
it up
too
the hill,
heavy.
and they do a little bit of buying, and then all of a sudden they stop buying, and the guy falls right back down the hill.
Yeah, it's like, I think your load is just too much. I can't do it anymore. Right,
So that's kind of the best analogy. Now,
right,
what they did a week later, in that next Monday, they said, okay, we're not going to limit it to 200 billion. We're going to buy whatever we have to buy.
right. So that was a key provision. But did they identify exactly what they're willing to buy?
No, but they've been coming into market every day and buying a substantial amount. And whenever they go into market, and that's kind of what we're finding in the morning, where you'll turn your rates on, and they'll tend to be better in the morning because they are buying.
Correct.
And then all
Right.
of a sudden the market falls apart and shoots up. Well, why? Because they quit buying.
Right. Now, I think I experienced that on Friday as well, because the treasuries, it priced really well. It actually, it looks like it had improvement for the day, but actually towards the end of the day, I did see conforming mortgage rates worsen. And by the time the market closed, I was off by 5/8
Oh, it's
on the
amazing,
point.
actually. And,
Right.
and where's and people say, well, where's that bouncing coming from? Well, I'm going to share with you, it's coming from a lot of directions, actually. Certainly, there's a liquidity issue. And if we talk about that mortgage-backed security, if we picture it a little differently, they're not really investments that were made with cash. They're futures that are made on margin. So these lenders
Right.
actually buy these futures on margin, just like you and I can buy stocks on margin.
Right.
And if we had $1 million of stock assets, we can generally borrow up to 50% of our stocks and, utilize that. But if our stocks go down in value to being worth $750,000, what happens?
Hmm.
The answer is we get a margin call.
Yes. If you get below, yep. Now that
And that
becomes where the
margin
stress
call
comes in.
means we have to liquidate our stock assets until we get to that point where we have, $350,000 worth of actual value, so that we now, rather, no more loan than $350,000 of loan in margin, because we
Right.
can't have any more than that to our $700,000 of value now.
Right.
Well, the same things happen to the mortgage lenders and the secondary marketplace. They have these calls. And this is kind of an oversimplification, so it's not exactly how the market works, but it's an analogy of how it works, so that we can
Right.
have a basic understanding. So don't take this verbatim, but more as a kind of a general analogy, right? So
Right.
now lenders are getting calls on these margins, and that's really put a lot of instability in the marketplace. So, you and I have had speakers come to Samcar that
Right.
have been in what we call the non-QM jumbo market. And now non-QM, what does that mean? It means non-qualified mortgage rules. So it's anything that isn't Chase, Wells, Bank of America, Citibank, US Bank, et cetera, who are limited to 43% debt to income ratio because of the qualified mortgage rule. Actually, it's the
Right.
ability to repay rule, but we call it qualified mortgage, whatever. Anyway, but so, and what that's created is a marketplace that was growing tremendously. So we've had these speakers come in and tell us about bank statement programs they would do, where you provide 12 months or 24 months of bank statements for a business, or, rental agreements for a rental property only, no income verification, a lot of
Right.
unique products, right?
Right. Things that were quite attractive at that time.
Exactly. And that marketplace just grew like 400 or 500% in the last year. Well, what we didn't talk about is this other side of mortgage banking, where the money actually comes from. Now, you work for a bank, and the money may actually come from your bank. Credit unions, the money actually may come from the credit union holders. But in the mortgage banking arena, the money comes from what's called a warehouse credit line.
Right.
So we fund that $300,000 loan. We fund it with a warehouse credit line, and we have a warehouse credit lender. And that warehouse credit lender says who we're going to be allowed to sell closed loans to, because they approve every single, investor that we would sell closed loans to.
Correct.
Well, guess what happened to the non-QM jumbo marketplace last week?
Did it just went into the Sahara Desert and just dried up?
Pretty much.
Right. Not a good thing, right? But it did.
Yeah, because twofold. They really got a double-edged sword. They had the warehouse credit lender saying, sorry, you can't sell to them anymore because we don't believe they're going to have the liquidity to buy the loan that we close for you.
Right.
So we had these huge investors, such as a name called Galton and Angel Oak. We've had Angel Oak actually at our SAMCAR meeting.
Correct.
That have just stopped doing business. Now, they put out a notice that says, we have stopped doing loans because of COVID-19, and we're going to cease doing loans for 3 weeks. We don't have any liquidity problems. We just want to be respectful of the marketplace and give the market a chance to stable out because things are so volatile right now.
Right. That sounds good to the public.
Seem to be able, Go ahead.
That sounds good to the public, doesn't it?
Yeah, the reality is we all seem to be able to be working from home, doing loans. How come they can't?
Right, exactly.
Answer, they probably really do have liquidity problems, don't they?
Right, they just didn't want to tell us. It sounded much better to present it as a COVID problem, not an access to capital problem.
Now, they may get through them,
right.
and taking a 3-week break, they probably really do have assets, but they really need the market to calm down. They need the warehouse credit lenders to say, okay, we'll allow the mortgage bankers to sell to you again. They really need that. And what they also need is to be flush in their futures that they bought and make sure they got liquid enough to be safe from their investors, because they invested all this money into what's called REITs and things like that.
Right.
Actually, Angel Oak's a unique thing because they did like 18 billion, I think, of secured assets, and they're actually able to package those into about $4 billion worth of mortgage-backed securities. So that's pretty good in the non-QM arena, but it's gone now. We I don't know about you, but we have like 22 different jumbo investors for American Pacific Mortgage.
Right.
And we had, I think, like 15, 16 of them just go bye-bye.
Wow.
And they were all the non-QM.
Yeah, see, our investors are all the big banks, like a Chase or a U.S. Bank and so forth. So it wasn't as disruptive on my end because we still can work with them.
But are you seeing, you're probably seeing the same disruption we are in even the Chase and Wells arena, because now they've come to us that we sell closed loans to them. Obviously, we have to follow their guidelines and rules. They're saying no cash outs, no loan to values above 80%. That's a huge effect on the real estate marketplace right there.
Right.
No non-owner occupieds. I mean, they're just going no new loans.
Getting a little conservative. Yeah, they're just being conservative and restrictive right now because of the uncertainty. So, because I guess in the 2008 crisis, what were the asset types that created that whole implosion? Investment properties, second homes.
So is this another mortgage crisis?
I think this is bigger. This is, to me, it seems worse.
It is worse because it's not just the packaging anymore. It's not, because the loans are packaged really well. They're underwritten really well. We don't have a quality issue of loans. We have a marketplace that buys the loans that's non-existent right now. I mean, Fannie Freddie buys all the standard Fannie Freddie conforming loans. They're the only marketplace. And the volatility that we're seeing, I'm being told, is coming directly from Fannie Freddie. It's not from investors. It's literally the Fannie Freddie market itself. It is a dog's tail that's wagging the market.
Well,
So
it's wagging pretty hard. I'm not sure if it's a happy wag or what kind of tail. What does it look like? But it's moving.
so what do we tell our clients? What do we tell our realtors? What do we tell them about purchases? And the answer is the purchase marketplace really hasn't changed very much, unless you want to do a high loan to value or low down payment purchase loan. You're going to find that pretty difficult right now, I think.
Right. That's an SLL type of transaction, right?
Yeah, and even the marketplace of these non-QM, they just don't exist. I had a realtor friend of mine that had contacted me wanting to see if I could do a loan that somebody else was already doing that was a non-QM loan. And it's like, no, we don't have it either. Sorry, it's gone.
Right.
Right.
One day it's here and the next day, well, not here anymore.
But I think there is some stability in different locations. In fact, I know it's not you or I, and it's not to my benefit to say this, but the credit union marketplace is actually a beneficiary right now, because the big credit unions, the ones that really do use their own depositors' funds, their members' funds,
right?
Not the ones that are selling on the secondary marketplace like we are, which are a lot of them.
Right.
The really, really big ones probably have some more price stability because they're insulated.
Right.
Their insulation is their own members that they do loans with. Now there are a lot of credit unions that we sell closed loans to. Those are very, very big credit unions, obviously.
Right.
But even they are not experiencing the kind of just immense movement of rate. We're seeing them much lower in interest rate than the Chase and Wells of the world. We're seeing them have a lot more consistency.
Right.
That might be a market temporarily that realtors could go to. I hate to direct them away from ourselves, but reality is they are a more stable market right now.
Yeah. So what do you think going forward the interest rate environment will look like?
I think it's a good question. There's a lot of things going on. Let's say this first. Where should they be right now? They should be a lot lower than where they are.
Yes, just based on the 10-year yield, it should be a lot lower.
It's not just the 10-year yield, it's the direction of the economy. Because what do interest rates do? They read the future of the economy. What's the future of the economy going to be? Probably some form of recession.
Yes, and this COVID just accelerated that eventual business cycle.
But then you look at the side of what the Fed just did, not Fed, what the government's just done with a $2 trillion package. And that by itself would be inflationary.
You would think, because people now you give more money to spend, yes.
Yeah, but inflationary generally means higher interest rates.
In a normal market, yes.
But you really can't have that when you don't have a market. So is it inflationary? No, probably not. And a lot of the package are loans. I mean, a lot of that $2 trillion they're giving away, rather, is you have to apply for it.
Right.
So some of it's going to just be given, supposedly, but businesses have to apply for loans to stay in business. And what's going to happen to those restaurants that have gone under and they've lost their employees and now they can't pay their rent for 2 months? Are they going to start back up?
Right. Hopefully. Yeah, see, that's the big question mark as this plays out. I mean, if we're going to be under, shelter in place for extended period of time, I think that could be a lot more damaging to the economy.
I think so too. And so the future, I believe, really is going to be lower interest rates. I mean, that I've been saying for 2 years that I think eventually we're going to see interest rates go down to 1.5% and 2%. And that was because of what was happening really in the world economy, how the world economy was on the edge or brink of disaster. And we're like this great big ship, that
right.
we're floating and we're doing really good. We had unemployment, down to this amazing number. And yet we're tied to all these other countries and they literally were taking on water and trying to stay afloat. Some of them are sinking. Now,
just don't say we're a cruise ship.
Yeah, really.
Not a good word right now.
Well, in a way we are, because we're all going to get COVID,
now,
right?
Can we?
Maybe. Anyway, so no, but in truth, but when those boats that we're tied to start to sink, they're going to make us list from one side to the other, but we're still going to stand up because we're strong. And that's going to be good for our treasury securities, because our treasury securities can be a place that money goes to, which is one of the things that is going to allow interest rates to go lower and lower into the future, potentially.
Exactly. So I think
bounce back hugely.
Right.
some huge big bounce back that would change all that.
Yep.
So I think that we really will see a market where rates go lower and people will be refinancing. Something everybody should know about mortgage bankers, though, that they may not know to support the marketplace is that, remember that concept we talked about, what happens to the loan that doesn't close
Right.
a little bit ago. So the rates, that rate that was locked in, and now we have this mortgage-backed security that we have to sell and win or lose money on the sale, and it's a huge risk. No mortgage to offset it. There's another huge risk in the marketplace that's causing this instability as well, and that's called early payoffs.
Hmm.
So when you and I originate a loan, with all of these investors we sell closed loans to, what the consumer doesn't know is that we as mortgage bankers have early payoff penalties. So
Right.
if for any reason that consumer pays off that loan, they sell the property, they refinance the property with somebody else, and that loan gets paid off within 180 days, usually that investor is going to come back to our company and say, give us our money back.
Right. That's true.
you know and so one of the things we want to help support is the world of interest rates by letting people know that refinance your loan, wait 6 months before you refinance again. Don't mess up the economy even more than it is, and then go back to your loan agent and have them refinance you again. And if you really have to refinance within that 6 months, go back to your loan agent that can work with the same investor potentially and minimize the cost that they would incur.
Right. That would make sense.
And that's the best thing we can give as advice for that. But also, going forward is to be prepared, because we are going to have this kind of bouncing back and forth until we get that great big guy that fell off the mortgage banking side of the hill that rolls back down, until the Fed pushes him all the way back up the hill and back onto the teeter-totter, right?
Right.
And we get that teeter-totter working again, because that reality is the lenders just don't have a risk system that's working. Until that happens, we're not going to see rates stabilize.
Right. And that's it. And so we're going to see in the short term lots of volatility and price swings. But I think in the long term, I think you're right. We're going to be in a low interest rate environment, and that in itself will help the economy, because if for every $100 or $1,000 a consumer saves on their mortgage payment, they can redeploy back into the economy and buying other durable goods and services. And I think that's what stimulates the economy. And that's why low interest rates are there, to stimulate the economy once we're back in normalcy. So.
Exactly. And, the other flip side of that is, as rates go down and people start to do that, we need to tell our clients to be prepared to refinance.
Yes.
And to have their documentation ready, not to call us and go, what are the rates today? And expect us to lock a loan in. Because I think you and I probably would say the same thing. If I don't have a loan, documented thoroughly, pretty much ready to be locked, where I can provide that information and already have an agreement with the borrower about what is going to benefit them and what interest rate and what cost, et cetera, it's just not going to happen. There's too many loans in the pipeline.
No, you're right. And that is the advice I'm giving clients. It's kind of like a resume.
Yeah.
Most people think you've been in a long-time job. I haven't updated my resume. At this point, you should get your mortgage resume ready, because you never know when rates are going to sit at a level that's most attractive to the borrower. And if the rate does hit that target price, that you can act on it. You can apply for that job. Otherwise, how can you apply for a job without the resume? Your chances of even being spoken to is not there. Same with the lender. If we're so busy being inundated with files, I'm going to definitely take the client that's ready, because I can only lock the rate with a completed loan application. So if they're ready to go, boom, they can act on the rate that they of their choice. So you're exactly right. I'm telling all my borrowers, get ready, because when the rate does hit that level, you can act on it. Otherwise, I can tell you any rate you would like to hear, but if you can't act on it, it doesn't really matter.
Yeah, right. In fact, why I brought up a week ago, Thursday and Friday, is because it was so relevant to what you're saying. I actually had a client that I wanted to lock in at 3.25 at par, at 0 points roughly. We'd already discussed it, and the rate was there, so I locked it, right? And then I had another one that had just called me and said, "Oh, what are rates?" And it was such a similar loan. And I'm sitting there trying to input the information into my operating system, get a
Right.
credit score. And while I'm doing that, I get the credit score, and I'm just about to go back in and pricing suspended. I go, oh,
Yeah,
great.
reprice. Yep.
Right. And then 3 3/4 for 3 1/4, 3 3/4, like, well, that was a waste of getting the credit score now, wasn't it?
Yeah, it's like great. That's exactly what happened. So I had to call the client this morning because it was that fact. She wasn't ready to go on Friday morning. The rate was better. By the time we got to talk, it went up 5/8 of a point on the same rate. And I said, well, if you had to been ready, you could have acted on it. So I said, we'll wait again. I'm sure it'll be priced better eventually. There's lots of volatility, but the fact is, be prepared. If you like the rate, I can act. And again, it just means having your loan package all ready to go.
Exactly. So that's the best advice I think we can give. And obviously, we've always pre-qualified borrowers for a purchase transaction.
Right.
And, but how do agents really prepare for this? I think the answer is you really have to use a much higher interest rate to qualify somebody on what has been peak of market versus what is
Right.
low, so that we know that going forward, that person is going to be qualified. And we're going to have to be more conservative going forward because lenders have changed their guidelines and rules. I don't know if you know this, but FHA has really been hit hard.
Yeah, I see those rates, elevate over 4%, 4.25 at times.
Well, what they've done is they've really hit back on credit scores. So we used to be able to go down to like 580 credit score
Right.
on FHA, and now they've got pricing hits. I mean, some of the major buyers of FHA are like PennyMac. PennyMac's a huge buyer of FHA loans, and we call them an aggregator. So all these lenders that we give closed loans to, like Wells Fargo and Chase, even in the conforming marketplace, they're aggregators. Um,
Right.
we can sell loans directly to Fannie and Freddie if we want, but instead we
Right.
sell them to an aggregator because they take on that hassle and they give us our money back so we can pay back our credit warehouse credit line, et cetera. It's a much smoother, easier way to be a mortgage banker than trying to sell to Fannie and Freddie directly.
Right.
These aggregators do the major of the work, right? Majority of the work, rather. But where was I? Why did I say that, Jeff?
I don't know. See, it's just like the market. Even our minds are getting volatile. Is that what it is?
Anyway,
That's what it is.
to give an understanding. But I think, like I was saying, that as we go forward, being prepared like that. Oh, I know what I was talking about. Getting prepared for purchases and things like that. How that marketplace can change and being tight to credit. We're talking about FHA. That's where it was.
Right.
FHA
See, now we're back on
scoring,
track.
yeah, FHA scoring changed dramatically. So now, if you drop below a 640 credit score,
Mm-hmm.
the points hits are huge. Like an example, what we call loan level pricing adjustments. It used to be like half a point worse for a score below 640.
Right. Or there really wasn't any. Right.
Now it's 3 points. And if you go to 600, it's 5 points.
Wow.
If you go to 580, it's 15 points. Seriously.
Wow, that's amazing. I thought
these are the loan level pricing adjustments. So the basic saying is, we're not buying that credit score anymore.
Right.
Because obviously you can't sell 15 points. You know what I mean?
Right. Things are tightening up, even on something that used to be so simplified as an FHA loan. Wow.
Yeah. And it's the jumbo marketplace tightening up, as we talked about earlier, how they're reducing loan to values, wanting better credit packages, wanting better credit scores, not allowing cash outs, not allowing non-owner occupieds. All these things are kind of what it's going to be temporarily until we get that great big fat guy down the bottom of the hill up to the top of the hill.
Rolling back on, yep.
And sitting back on that teeter-totter and having that teeter-totter go back and forth. We got to get that risk system back in line for lenders before that marketplace is going to return.
Right. Well, I think it's crazy times. It's a lot of unfortunate things happening, but I think those people who can just kind of get a grip of what's really happening, especially if they're homeowners, this is a time for them to take a little temperature of where they're at and where do they want to be, and do they want to take advantage of their home and ease some of their credit and some of their obligations, because rates are so good and they will be good that this is their way to help themselves and help the economy. So I think homeowners are going to benefit from all this.
And I also think some of the things that we should be talking about, since we're now talking about refinances, some things that we should be talking about with people going forward is not just reduction of interest rate, but also improvement of life. Now, granted, we're not financial advisors, okay?
Correct.
We're mortgage people, but we can talk about instruments in their lives that are important, because as we reduce people's interest rates, do we really help them? And I'm going to share with you, sometimes we really don't, because though somebody has a 30-year loan they got 5 years ago and they have 25 years left to pay, we refinance them. Even if we do a no-cost refinance, we reduce their payment $200 a month, and they go, oh, I've got a $200 cheaper payment.
Right.
That they're now going to pay for 30 years.
Well, yeah, so it wasn't apples. Yeah, it wasn't
when
apples
they had 25 years left to pay. So I know my advice to them, I'm sure yours is too, keep paying what you've been paying, so that you keep your loan on an amortization period that's faster. And the same amortization period that you would have had before is actually going to probably be 2 or 3 or 4 years faster just by paying the same payment because you reduced your rate.
Right. And that's the better way to approach it if the goal is to save money, because then you would.
But also, I think we should ask them questions like, are you maximizing your 401k plan at work? Because some people don't even have one.
Right. Well, hey, with the extra $200, for example, now you can invest it instead.
Well, and maybe they don't take the $200 payment savings. Maybe they take $150 payment savings, but they put $50 a month into, or per paycheck, into their 401k. Really, I think they can go up to 14.9% or something like that in 401k. I'm not really sure the exact number, but that's a reality of some direction that we as loan agents should be giving people. Talk to your CPA, talk to your financial planner, talk about where else you could be investing your monthly expenses that will benefit you on a long-term tax basis and also benefit you from a mortgage basis.
Right. No, it's a good concept of paying yourself first.
Exactly.
Right. So I think, if people are not sure what that means, look it up. Or there's a great book, The Richest Man in Babylon, something way back eons, centuries ago. And one of the concepts that was really stressed then was always pay yourself first, the 10% rule. Above everything other than your other obligations, give yourself 10% before you pay your expenses, because that's how you accumulate wealth. Well, you can use your home as that type of instrument instead of thinking, hey, I just lower my payment at $500. Well, now that you did, take that $500 and pay yourself.
Exactly.
Invest it, save it, do something productive.
Exactly right.
Yeah, I think that's a great concept. It just takes discipline for people to do that.
Right. And obviously there's even lower rates available in some of the 15-year loans and 20-year loan instruments. But, I tend to shy away from those with people, because especially older people who really are more likely to have that shorter term loan because of the health risks involved, so to speak. There's a risk of health as we age. And, as we have a 30-year amortized payment, let's say our payment's obligated at $1,500 a month, but we're choosing to pay $2,500 a month. Well, we're choosing to pay $2,500,
which is a great choice.
What happens if one of us loses our job or one of us has a health issue? The answer is, I really can pay the $1,500 if I need to.
Right. You have that flexibility. Yes.
So I think that's an important thing as we look at some of the 15-year loans that are out there. Who fits that? Who has enough income, assuredly, to be able to have that payment? And that's the person that should get that shorter term committed loan. It's not a risk for them.
Correct.
They don't have that kind of risk. So anyway.
No, I totally agree.
I think we covered an awful lot.
No, we did. For Saturday, that was quite a bit. No.
Yeah, really, huh?
No, that was great. So this is good, and I like.
Guess what happened Sunday?
What?
It's my birthday.
Oh, well, happy birthday! Fantastic. Really? I was going to say, what are you going to do? Where are you going to go?
I'm going to Skype Disneyland.
Oh, fantastic! Ride all the rides. Yeah, you won't even get sick if you do it that way.
Yeah, really, yeah.
Because those teacups, I used to be able to ride the teacups, and I can't anymore.
Yeah, we're using Zoom right now. My wife and I talk about having a Zoom cocktail party.
See, that's fantastic. I just can't taste what you're drinking, can I?
Yeah, really. Anyway.
Well, fantastic. Well, happy birthday. Awesome.
Well, thank you,
Have
buddy.
a good time celebrating with at least with your immediate family and all your Zoom friends, or however you want to share this with. It's fantastic.
Yeah, you know what it'll really be? It'll be hanging out at home just like today. So anyway.
All right. You can take some virtual golf swings, right? That's pretty fun too, isn't it?
I have played golf.
Oh, well, that's okay. You're definitely 6 feet apart, right?
Exactly.
Hundreds of yards. Okay, that's better.
They actually took all the golf carts away, so you have to walk. So it's
Hmm,
healthy, you know.
that's okay. Yeah, get a little exercise, and it's a nice way to play golf. I like walking before. Cart's a
You know,
lot easier now.
let's kind of end this by telling everybody, you know, we wish you all really, truly health and wellness and staying protected, staying away from people as much as you can, because, you know, though you may not be sick, the reality is you can be a carrier. And
Right.
as we really protect people from staying at home, we protect our economy, our real estate, the people that will buy homes, their children. You know, we really need to take care of ourselves to take care of our world and our finances. And you know what? Our finances are going to end up being fine.
Yeah. No, I agree. I think that is the number one priority. Take care of yourself and your family. Stay healthy and safe, and everything else will work out. That's how life is. But know your priorities, and your health is number one.
Exactly. So everybody at Sam Carr, if that's who's seeing this or anybody else in the world, we wish you well, good health, happiness, and love.
Ditto.
Peace out,
Take
baby.
care. All right. Take care.